The meltdown in Bitcoin and strategy continues, and I thought maybe we should take a look at where strategy's value is relative to Bitcoin with a little bit more specificity today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. In the past several live streams, including on office hours yesterday with Professor Mark Guthner, we did discuss some of the critical levels potentially in Bitcoin. We showed that chart that I know Carter Worth had showed with Dan Nathan and Guy Adami on their channel. We can bring that up again if we choose. One of the things, though, that I think is worth examining is if we are now getting to a level where there is some additional sort of convexity, if you will, in strategy stock. And to do that, because I've sort of been doing this in a very thumb-in-the-wind process, but I wanted to go over some of the details about the way I think about this a little more specifically today. And essentially, I have been using this kind of rule of thumb, a guideline, if you will, of the debt on strategy's balance sheet, which is convertible, as essentially having an impact that was dilutive to the tune of about $10 billion or so. But actually, now that the share price declines, I think it's fair that we need to actually examine how these securities work and essentially what accrues to the equity holders and what accrues to the debt in the event that Bitcoin stabilizes or starts to go higher at some point. Now, as we had pointed out, actually, let's start with that. So just as a backdrop, as a framework for this conversation, the chart that we had been looking at, I believe, yesterday was a long-term logarithmic chart that goes back about 10 years. So I will do that now. Let's go back to, can I go back to June of 2015? Looks like I can. Let's get rid of these moving averages. So for anybody who did not join for that, this is essentially this long-term chart that we're talking about. And this is sort of a separate point to the broader conversation that I intend to have here. All right, so maybe we look at this. I think, so this is the trend line that has been discussed. And I think that as we look at this now, it certainly looks as if it has broken that long-term trend. Now, if that's true, then the next question is, what's the next stop for Bitcoin? Again, that's not the complete conversation that we're having here, but I just want to give this as a little bit of a backdrop so that we can then start thinking about strategy and how we value it. And what am I doing here? Speak to USD. All right, there we go. Oh, I know what I'm doing. Sorry. That's what Now, again, I'm not a big technical analysis guy, but I know that other people care. So we're looking at this level here. We're fast approaching it right here, right in the mid-80s. And then the next stop down here in the mid-70s. All right, so that lower level, let's just talk about that for just a moment. That would be a discount of about 17% from here. Okay. So, knowing that, let's take a look at what exists on Strategy's balance sheet and how we think about this. So, I'm just going to blow these numbers up so hopefully they're visible to everybody so they know what I'm talking about. So what I'm looking at here is when I hear people say, oh, well, they're trading at approximately the value of the Bitcoin on their balance sheet, Strategy owns approximately 650,000 Bitcoin. Okay. And there's a market capitalization of 53.5 billion bucks as of today's current stock price. But the 650,000 Bitcoin aren't owned exclusively by the equity, because the debt that's over here in these two lines, convertible preferred and convertible debt, has equity participation. But they don't get equity participation at spot. So when the price is very high and the stock is close to the convert, then one way to think about it is you should essentially fully dilute it. But when the price of the underlying asset, in this case Bitcoin, is substantially lower and the share price is lower, and you think about its potential recovery, a higher percentage of the potential appreciation in Bitcoin's price accrues to the equity holders until you get to that convert strike. So we actually need to keep track of what those convert strikes are and how much that represents. So to do that, we have to take a look at all of these different securities and their respective terms. And we can do that here. So let's start with the bonds. And we have 7 convertible bonds. And I had actually started to do this. But I'm just going to quickly show what we have here. I'll just start at the top. And we'll take a look at the description for this security. And there's 2 parts in all of this that we care about. So one is the amount outstanding. That's here. And notice that this is not $3 million, right? There's a multiple here. So this is actually 3 million times 1,000 is 3 billion. And this is the convert strike. So this is really relevant, right? Because on this convert, for example, this is a 0. You can see that the convert strike is way out of the money. So in other words, the immediate appreciation of the underpinning shares isn't really dilutive to the current equity until you start approaching that strike, because then after that point, then it's you would fully dilute at that point. This is the other part you have to think about, which is the ratio, right? So it converts to 1.5 x. But this is really the important point. 672 is well above the current stock price, right? So it's really not that much in play. If you're thinking about Bitcoin doubling, or in this case tripling, essentially most of that benefit would accrue to the equity for this tranche, for this 3 billion bucks or so. Now that's not true for every one of these. So if we go back, and one of the reasons is that when these things were initially issued, what Michael Saylor recognized, to his credit, was that the volatility of his own shares and the volatility of Bitcoin itself could be harvested, because the higher the volatility is, the higher the value of an option. And if you're going to do a 0, so you don't have to pay any interest on the debt and it's going to convert into the equity, if the volatility is very high, you can push the strike further and further out. So look at this tranche. It's high, but it's not as high, right? So for this one, another 0. But in this case, and it has a big conversion ratio, but in this case, the convert is 433. But that is still considerably above the current stock price. So still, for these, which is another $2 billion worth, most of the benefit, if Bitcoin were to double, in fact, all of the benefit of a double from here and a little bit more, would accrue to the equity. All right, so that's also positive. But then we just work our way down. We'll go to the next one. What are we looking at on this? Okay, so for this one, now we have a conversion price that is right here. So we're basically at the money for this one. This is $1 billion worth. So for this purpose, so this is, we definitely want to take the market capitalization. So that is immediately dilutive. So that's $1 billion. And as we go down to the next one, we're going to do a similar exercise. I'm not going to make you suffer through all of the preferreds, but I just sort of want to give you another sense of it. This one's in the money, so that is fully dilutive. That's another 0.8. And so on. Now, I think you can see where I'm going with all of this. We'll just work our way down. I've only got 2 more anyway, so might as well just show them. This one's just out of the money. 232. 600 million. Back up again. This one's basically at the money. It's another 800 million. And then we'll just do the math on these. So what we got here. And this one here is 3 billion, way out of the money. So that's 1.4, 2.2, 3.2. So 3.2 billion of the bonds are, we essentially should dilute the shares for $3.2 billion worth of the bonds, so that we can add that to the market cap if you want, or we can, just, and either way, it doesn't really matter. I mean, the real point is just ensuring that we kind of account for it. The reason for this exercise is because at this point, so these preferreds are basically a hybrid, right? So these are perpetual preferreds, but this one is convertible. So we do want to take a look at that. And the conversion price is 1,000. Doesn't really matter. It's way out. Okay, so what does this mean? What it means is that if you're looking at strategy, you don't get to, because of those other convertible securities, it's not like you own participation in Bitcoin ad infinitum. But it is safe to say that you get to have, essentially if we dilute by the 3.2 billion, so that gets us now to 53.6 plus 3.2. Now let's round up. We'll call it 54 billion bucks. And we have Bitcoin trading at 89,000 in round numbers, and there's 650,000 of them. That's $57.8 billion. So immediately, if we think about it right here, you actually get better participation for the first double in Bitcoin from here, effectively, being long MicroStrategy. I think we're getting really close in terms of a buy juncture. Technically, things are clearly broken, which is a separate issue. But just functionally, is this a good way to play it to the upside? I think the answer is yes. And so I'm probably going to dip my toe in the water here and pick a little bit up. Like I said yesterday and the day before, I would like to see maybe 86,000 as a place to start acquiring a little bit in case Bitcoin stabilizes there, and then 75,000 in Bitcoin. So I'm going to use the price of Bitcoin to essentially tell me, are we getting to a point where we should start acquiring a little bit? But I think this is pretty interesting. And, in terms of option strategies, we are seeing options vol tick up a bit here too, right? So we got a really good question on whether or not a 1x2 put spread in strategy made sense. And those types of strategies become increasingly attractive as the stock comes in and vol goes higher. It has now done both since Monday. So now let's just go back to that December. It was the one we were looking at was the December 190, 170. Nice. Okay, I'm just hearing that somebody in the comments did a 1 180, 162. Let me move over to the comments to see here. I ended up opening a 180, 162 for a 280 credit. Downside break even 141. Nice. I like that. I like it. So I bought winter in August at 30. It's now at 37.61. This week's distribution is a whopping 85 cents. Is the yield coming only from selling options, with the NAV being driven only by changes in MSTR? So yeah, that's a. Let's talk a little bit about that at a high level. The funds, obviously, winter has done well. So for those who don't know, I'm associated with the YieldMax family of ETFs under Tidal Financial Group's umbrella. There are some single stock covered call ETFs, and then there are kind of the inverse proxy of those, which is short the common or short a proxy for the common and short downside put. So if you can think of a covered call as being long the underlying and then selling calls above to collect premium, we do inverse. So we have Misty is probably one of the better known ones on the long side. Long MicroStrategy, selling covered calls. MicroStrategy has performed abysmally, as we just discussed. In fact, since July 16th, the total returns for strategy, we'll just take a look at it here. Oops, nope, sorry, wrong year. I want to go to this year's highs. So strategy is down almost 60% since July 16th. Terrible. Misty, which is trading covered calls on it, is also down, but down considerably less. Why is it down considerably less? Well, because you've been collecting distributions along the way in the form of short premium. Now, some people will say if you sell covered calls, you get the benefit of getting premium, plus you're hedged to the downside. I don't like it when people describe these as hedges to the downside because, of course, it mitigates downside, but being short calls is not a hedge against these kinds of precipitous declines that you're seeing in the underlying asset. Had you simply taken the distributions, you've got, 46.5% decline since July 16th. But we don't just run a long short premium strategy on strategy, formerly MicroStrategy. We also run a short one. And as you would expect, that's done a lot better. Had you reinvested the dividends since July, that one's up 75%. And if you had not reinvested the dividends, you'd be up 61%. Astute observers will notice, well, wait a minute. It looks like if I was long the long one and long the short one, I'd actually be up money at this point. And the answer is that's true. You actually, had you put that on as a pairs trade, dollar for dollar. So if I bought $100 worth of winter and reinvested the dividends in it, I'd have $175. And had I invested $100 in Misty, I'd have about 50. So what that means is that I would have started with $200, and now I'd have more than $225 if I'd reinvested divs in both cases. So that indicates that I would have had more than 10% returns in 4 months, being long the long one and long the short one with the same underlying asset. Not always going to take place, but that's partially a result of the fact that we've seen an uptick in volatility. So you're harvesting more premium as this happens. So when you're looking at winter's share price, the share price is actually what you're seeing here in white. And the total returns are what you're seeing here in orange. So, and the little blue boxes, this reflects the individual distributions that these funds have given out. Now, with respect to share price appreciation, over the long run, it is very difficult for single stock strategy ETFs that hand out big distributions for the share price to go up. You can have very good positive total returns if the underlying strategy is a good one. But the share price appreciation, now we have had good share price appreciation in this time frame, as you can see here, 23% or close to 24. But it's difficult to preserve that situation over a long period of time. And the reason that it is difficult to do that is because of the RIC rules. And the way RIC rules work, you can't get outsized positions in the underlying asset. So if the underlying asset grows to be too big, you have to reduce it. You have to take profits. And if you take profits, now you're getting outside of the RIC rules and you're getting into the IRS rules. And the IRS rules stipulate that to be a pass-through entity, you must pass 90% of all the interest, dividends, gains, and everything else that you collect inside of a fund back to the shareholders, or the RIC, the registered investment company, gets taxed as a corporation, 30% taxes. Nobody wants that to happen. So it is easier for diversified funds that have long-term holdings in underlying stocks that never violate concentration rules to maintain appreciated stock positions without ultimately passing those back as distributions. So I realize there's a whole lot to unpack in all of that, and I hope I kind of explained it a little bit, but this is not an area that's that well understood. And I can tell you I know it's not well understood because I have tried to explain this to people whose business it is to evaluate funds. CFA charter holders whose job it is to understand the difference between a fund and a strategy, to know RIC rules and IRS rules, and they just don't. And maybe it's because they've got too many to look at, so they have a hard time, kind of digesting it. But, there's a couple different pieces that all have to sort of fit together. One of the reasons I like diversified funds that have a very, very stable core equity portfolio is because you don't run into that problem. You don't end up being forced to pare back an equity position because you violate a concentration rule generally. So, in something like Biggie, where you have just the top 50 names in the S&P, no one of them is going to get so big that it's likely that you have to sell and realize gains. And you just basically pass back all of the premium, and then hopefully you get some appreciation, and it all works out nicely. So, yeah, it depends a little bit on the circumstances, but unfortunately, long-term fund share appreciation. Yeah. Yeah. So the yield. Yeah, the yield is not only coming from selling options. That's correct. Yield comes. Yeah, when we pass back a distribution, the distributions are a function of whatever money has been made from whatever source, irrespective of what may have happened in non-distributed funds. Right? So you make a gain in the shares, you have and you realize it, you have to distribute it. You sell options premium and it expires worthless, you got to distribute it. You get interest on the collateral in the fund that you have in cash and equivalents, you got to distribute it. And that's one of the reasons why typically in these high distribution funds, it's not just these, but you look at this and you'll see, why do the share prices keep going down? And that's because anytime there's any money, you have to distribute it, basically. It's a kind of a simplification, but I think it does also kind of illustrate the point. FinWest, NVIDIA earnings numbers are good. Let's see how this pushes the stock. It was very interesting today. Let's see what's going on here. The stock was so far so good. I really, obviously I'm hoping that this, holds in there for tomorrow. We acquired 400,000 shares of NVIDIA last week, and, so far so good. It's, things don't grow to the sky. But the point I've made about NVIDIA several times, and I'm sure you guys have heard me make it, is that, the company is not expensive. I think the Did I coin it? Is it a cute saying? I don't know. What I have said is that it is a very valuable company, but it is not a very expensive company. Not just NVIDIA, by the way. I think the same thing is true for Amazon, for example. Valuable, but not expensive. Measured very simply by what you are paying as a turn for forward earnings relative to that earnings growth. So right now, the street's looking for, and this number's probably going to go up, right? So results being what they are, how much did they beat by? So Bloomberg's data is not updated. I have to go to their investor. Oh, actually, wait, what am I doing? It's probably in the news. So this will probably update while we're on the so revenue beats, and what was the earnings number? Revenue $57 billion, beats by 2. Adjusted gross margins, that looks like that's in line. Adjusted operating income, so adjusted EPS was $1.30. And what was the street looking for? So the estimate was $1.25, $1.26. It's a number right there. So it's a modest beat. But it's a beat. And it beat on the revenue line. And it looks like their guidance is pretty good as well. So beating the numbers by a couple of cents. Let's just say that analysts take their targets up a little bit. Maybe this number gets to 7. Over the course of the next, from now till the end of the year. Maybe the adjusted EPS estimate goes up to $7. Stock's trading, we'll call it 190. That's the price that you see in the upper left-hand corner is the closing price. We just saw, that's 27. 27 times forward earnings on 50% annualized growth. Now, I don't expect 50% annualized growth to go on forever. How could it? Because that means you're effectively doubling less than every 2 years if you have that kind of CAGR. That's not sustainable for a $4.5 trillion company because it would not take long at that rate of growth for a company this size to swallow. Essentially, if you extrapolate from that number, you can't do that because you're going to extrapolate to the point that NVIDIA is the economy, that it would be as big or bigger than everything that's out there. That clearly doesn't make sense. But even if it stabilizes just to long-term GDP growth or something like that, that's still, a very reasonable turn, one could argue. So, that's that kind of the point I've been making. It's amazing that when you screen the Russell 1000 and you're trying to find companies that have good top-line growth, good bottom-line growth, consistent growth through time, stable or rising revenue and earnings per share estimates. You start screening on all of these things, which are positive factors, that say, okay, these are companies that I'm interested in investing in. What you find is that the same names keep coming back again and again, and it's all the sort of same familiar ones. And it's all the same names that everybody says these things are so expensive. Expensive is how much you pay for earnings on a valuation, on a turn. It's not the value of a company. Somebody could say that a Ferrari, 1960 Ferrari GTO is expensive. It's very valuable. It was expensive when they cost $5 million, and now they're 50, right? So I think we have to maintain some perspective on all of that. So let's get back to the strategy conversation because I think this is rather interesting. I just want to construct this trade because I bet you as of the close, this thing's looking even better. And Steve, I'm pretty sure this whole thing started with your idea because I'm pretty sure you're the one that brought this up. And actually, I was going to bring this up to internally some of our fund managers, because I really like this as a trade. The issue that we have is that, most of the funds inside of our umbrella tend to focus on maximizing theta. That tends to come from selling shorter dated options. And this is really a combination of vol harvesting and directional bets, and frankly, just a little bit of Vega, which is a different thing than what some of these income funds do. But let's just do this. We're going to put some puts in here. We'll do a ratio. And I'm going to choose the... you said you had the 180, 162.5, I think you chose. 180. I mean, even the 160s, I'll bet you. Holy smokes, is that the case? Look at that. Can I go down even further? Wow. I mean, now this is just incredible. This is the even money trade right now if you went out to January. So this thing has a downside break even of $120. Now, I've already said that strategy is at this point trading very close to even versus Bitcoin. And that's 186.5. So that 1x2 reflects more than a 35% decrease in the price of Bitcoin, which gets us down to around 57.5 in Bitcoin. Let's take a look at when the last time Bitcoin was there. Now, it's very easy to get all giddy and overexcited about situations like this, but it is interesting to me that, sometimes people really start panicking and you start thinking, this has got to be something we can start to take advantage of. And man, does it start to feel like that at this point. Let's go back now and see what levels we're talking about, right? So you have to get down to in here. Right, so this is it's down in this range right here. That's effectively where, if you did that 1x2 that I just showed you, that's essentially where you're going to be. If you are put to stock, effectively you're being put Bitcoin at just under 60 grand. Right over here. That's considerably lower than it is right now. And I think this is a good chart to keep in mind for other reasons, right? Because this is a volatile asset. And, end of 2022, it was actually below 20,000. Do I think it's going to go back to that level? I don't really. I mean, and that's, is it so ambitious to make such a claim? Oh, I don't think that it's going to fall, another 70% or whatever from where we are now. But I do think that these 1x2s set up really interesting trades. And so, again, I'm going to thank Steve for bringing this to, into the conversation, because I think it's really quite valuable. So I was going to put it on yesterday, and for most of the day, strategy was up 10. Then it came back down today. Yes, yeah, it did. I chose the 162 short put to give me a little more credit, as I suspect this trade will expire out of the money in a month. Yeah, so that's actually a really good point too, right? So, for those of you who are looking at this, the question you may want to ask yourself, let's bring this back up. And let me modify this because I think you were looking to December. So we'll just back this up. 44 days, that's kind of that tasty trade. They love to sell vol around 45 days out. So we'll just focus on January 2nd. Takes you to the next year. Maybe you're going on vacation. You don't have to think about this while you're traveling. Not bad. Let's think about this, right? So if you do what Steve is doing and you bump this up, right? So 180, 165, this thing is going to collect $7, have a downside break even that's going to be the distance between the strikes, because you're going to make 15 on the way down, of 150, less the premium you're collecting. That now gets you down to 143, right? So that's effectively where you'd be long strategy if it's put to you. But in the meantime, you're going to be collecting 7. If it does not do that, if the stock does not fall any farther, you are going to be collecting $7.10 in premium over the life of this trade versus 186.5 stock, which is almost 4% in a month and a half. So not a bad yield either. And, tinker with this yourselves to get to that sort of happy place, whatever that happens to be. Trying to find a balance between, am I actually going to press a bearish bet here and believe that another 15 to 20% downside is possible and look to profit from that? Or do I think there's a possibility of a more modest decline, but also potential rebound, in which case I'm looking more for some standstill rate of return, which pulling that downside ratioed strike up a little bit will achieve. That's essentially what you're going to be doing if you do something like that. The one thing I would say, though, and it does feel panicky, but it has real panic set in. So we violated all of these levels, and we have seen a pretty big uptick in volume, but it is not as high as it's been, right? Let me draw a little annotation here. So I'm going to, actually I don't need to. I can go do like this. So we can definitely see that volume has ticked up. It would be really nice to get something like this, right? Where you get a really sharp move accompanied by just a massive amount of volume. People get completely washed out. And we haven't quite seen that yet. But I do think we're getting close. And I intend to put a little of this on myself, because I just think the setup it's a very nice risk-reward relationship, right? Am I going to get all panicky about potentially being long strategy at in the 140s or even potentially lower? I mean, we saw you could do that 180, what was it, a 180, 152 and a half long down around 119. I mean, that's a big discount. Another possibility, this is not the way I would do it personally, but I think it's worth thinking about, is Carter, and I actually haven't asked him, I probably should, but he likes to sell premium on both sides. He's more agnostic in some respects in terms of direction from time to time. He also wouldn't go out this far. But, at some point you can also start looking at, for the more intrepid, people can start taking a look at selling upside calls and downside puts and looking to harvest some premium against it that way. My only issue with this is that if you're a I don't really like to get naked short upside unless I have a really big buffer in things where my general view is that I'm bullish, and my general view on risk assets is that I'm, as most will know, generally pretty bullish on most stocks and most risk assets. But I do think it's also worth considering that for those of you who are maybe less sanguine about getting long Bitcoin here, which is what a 1x2 would potentially do, although you're going to get long at a considerable discount. If you're amongst the naysayers, then maybe now's the time to start looking at selling some upside premium as well. I think that's quite all right. Let's talk a little bit about another set of stocks that I was looking at today, which was the casino stocks. Oh. Oh. Did somebody just ask that? Let me get over here. You think buying long-dated calls on MicroStrategy is smart right now, going out to January 2027 and selling premium around it? Well, to figure that question out, let's take a look at the term structure. Like I said, vol is higher in strategy at this point. Let's see how much. So January 2027, it's around 80 vol, looks like. You know, I believe I showed earlier this year, I think I actually showed a long-term buy right. And I would just like to do that right now, because I think when we think about this, you know, oftentimes buying a long-term call and selling shorter dated premium against it is appealing, because we refer to that sometimes as a poor man's buy right. The issue I have here is that when vol is this high, it's not really a poor man's buy right, because those options can be really quite expensive as a percentage of the current stock price. So we will go out to January of 2027, and you will notice that a 190 call is almost 63 and a half bucks. That's pretty chunky, right? So let's just say, for the sake of argument, that you said, you know what, I think that MicroStrategy could rebound by 50% from here. All right? So 50% on 186, that's 94 and a half bucks, right? So that's like 280. That gets you to this. So the question you can ask yourself is, would I rather buy the stock at 186 and sell a 280 strike call option, $100 out of the money, for $38 against it? You know, that's not so bad, right? Or alternatively, you know, sell nearer dated premium. I would focus on selling nearer dated premium against maybe long equity, because one of the things that could happen here, if you look at that term structure, here's one of the things you're going to see, right? So, oops, where did that chart go? Here it is. Okay. I realize this doesn't look like a whole lot. The difference between this, by the way, this red line, this is only the difference in vol over the course of 1 week. So one way we might think about this is, let's take a look at how low 1 year vol got in strategy. And I'm going to do that this way over the course of the last year. I'm going to get rid of this, so we're not looking at them. It got down to 60. Right here. Okay. So what does this mean? What this means is that if you buy long-dated vol here, going out 1 year, right? So it's 80 now, right? It could go higher, and it has indeed been higher. But I think it is important to point out that the general trend for crypto has been that vol's been going lower. So if you buy that long-dated call, you have the potential to win in Vegas space, as well as if the underlying asset rallies. But is that really my expectation? I'm not so sure. I don't think we're going to get back to these kinds of levels of volatility, because the general trend has been, as the asset class has matured, vol has come in. Vol has come in for Bitcoin. It's come in for other things in the crypto space. It has come in for Coin and Marathon and some of the mining companies. So a lot of the vols are lower. I get a little uneasy about buying really long dated high vol. In fact, I mean, I can distinctly remember a trade many years ago when I got plowed on some straddles that I thought I can make a market in these things because there's a good bid generally. I'll be able to sell some premium. And, all of a sudden the bid for vol, just the bottom fell out. Like once the turmoil that stock was facing suddenly abated, every bid for options premium fell apart, and there was just no bid for long-dated vol. And it was a very painful exercise. So my inclination would be probably not in this case. Let's quickly examine, I think it's worthwhile, what a 20 vol decrease in some of these options might actually mean in dollar terms. So let's just say, for the sake of argument, we go to January of, let's look at the 200s, okay? So, or the 190s, so nice out of the money strike. So we're going to pick these, and we're going to assume that you pay close to 80 vol or whatever the system is currently saying that's going to cost you, 81.5. Okay, now let's imagine that over the course of time, over the next 3 months or so, that implied vol goes back to that 60 level. Okay, so we're going to put 60 vol in here. And let's say that happens in 100 days. So there's 321 days left. Oops, let me do this first. Let's just remember this price. Okay, so this is the price up here. $64.50 a share, $6,450 a contract. Now I'm going to advance the clock by 100 days. And I'm going to take vol down to 60 on a standstill basis. So at that point, less than a quarter of the time to expiration has passed, but you've lost half of the value of that option. That $64.50 option, not half, but you've lost a third of it, right? In less than a quarter of the year because of that decline in vol. So that's one of those risks you kind of have to bake into the cake. And just looking at buy rights, Steve Garcia, May 280 call, 32 delta has a P&L 65%. The Jan 27's 49 delta has a P&L roughly 90. Yeah. So I think, oh yeah, look at that. Yeah, this, by the way, in case you're wondering, that's not my phone number. I don't know whose phone number that is. And I'm not at 4400 PGA Boulevard either. But that must be where all of these terminals are licensed at. It was probably one of the firm's offices in Florida. Yeah, so if you're trying to reach me and you call that number, I don't know who you're going to get, but it won't be me. Is 402 is that a Florida area code? Somebody can tell me. So, short version is I kind of prefer to be on the short premium side here. I just think that the setups are so much has to happen for a long premium bet in something with a vol that high to really work out. As many of you will know, there have been circumstances when vol got very low where I was constantly advocating for, get long calendars and diagonal call spread riskies and things like this. But that was during an environment where we were just generally very low vol. We had the VIX chugging along around 15. It was at 3-year lows. A lot of these stocks didn't have very high vol, and the break-evens were pretty good. Strangle swaps. But this is not as true in some of these higher flying names, especially now that longer-term vol has gone up. And if the underlying asset starts to recover, I fully expect vol will start to come in. Could go higher because we haven't seen the complete panic. But trust me when I tell you that the bid for longer dated vol can come in harder and faster than you think. It's been a very painful exercise for me. I can tell you that it's probably 99 and that type of thing. It probably cost a stick anyway. It's 450, 500 straddles in Tyco International, and that was, it was a lesson you don't forget. So that's something to think about. Okay, let's see if we got any other questions here that are worth tackling before I move on to the gaming stocks. Let's look at those. So, these have had a pretty good run, and I was taking. So, how did I start looking at this and wondering, is it time to start selling some call spreads in some of these things? What got me in this direction? I was not screening for short ideas. What I was doing instead was I was just running the regular screens that I look at on the long side. Some of you will know. So what does that involve? Anybody who's watching who hasn't seen this before, I'll just go through some of these exercises. And I'm going to this is not going to be exactly the way I do things, but it will give you a quick sense. So I like stocks with momentum. So I want it to have a price that's better than, it's going to be above the 50-day moving average. We'll start with that. So in a universe of 1,000 stocks, that's gotten rid of almost 70% of them right off the bat. What are other things? I don't like to buy companies where analysts are in the process of reducing estimates. So we'll just say, I don't want anything where they've brought their estimates in over the course of, for either revenues or earnings, over the course of the last month. All right, we're down to 18% of the Russell just with those two things. I don't like overpaying for growth. So I'm going to say, all right, well, I want to have, this is just because it happens to be the average. So that was an arbitrary number. It isn't necessarily the one I would use. I would say, okay, I want to have a price earnings to growth ratio that's less than 2.7, which was the mean for this subset of stocks. Now I'm down to 106 stocks. And I can start, scrolling through this list and seeing whether something is of interest to me. Well, what happened to me earlier today was that in the course of this work, I wanted to just take a look at how the top quintile of some stocks were performing relative to the bottom quintile of stocks in this universe. So using factors like these, because I tend to look at things on the long side, I was wondering, okay, how would this work as a short bet? I don't know how many times I've come on this. Have I ever come out and said, okay, I think we should short this, we should short that? I don't do that very often. I think people should generally be long equities. But it's fair to say that some stocks have had a pretty good run. And in the course of doing that, I happened to find that Wynn, Las Vegas Sands, and I think Caesars all landed in this bottom quintile. And so I was, saying, oh, well, I wonder whether, what's going on there? Is this something where we should start looking to fade it? And then I happened to notice, oh, okay, so Wynn is, bumping along its 100-day. It's below the, now it seems like it's fairly definitively below the 150, but it's still higher on the year. And I thought, well, maybe, not necessarily an outright short bet, but maybe we can fade the upside, especially since it's not like this is a really low volatility. It's 40 vol. So let's take a look at how one might do a trade like that. Now, I will then add as an additional disclosure for this, and I will not take credit for this, and I don't know if, well, maybe the person internally, he doesn't want to take credit for it. So I'm not going to mention his name, and if he happens to watch this and says something about it. But at the exact same moment that I was looking at this, someone senior at the firm was saying, I think it's time to fade Wynn here. Not my idea, didn't come from me. And I just responded, isn't that interesting? I don't, coincidence? Who knows? It just so happened. So what are we looking at here? So what I would think about is selling. I'm going to make these calls. Possibly selling an upside call spread in here. Let's see if we can find a nice one. Let's see what we got here. something along these lines. So effectively, you're saying, okay, I don't think it's going to make it back above the 50. That's essentially where we're picking our short strike. It's got a standstill rate of return of $3.30. This one's expiring on the 26th, so not really all that far out. Standstill rate of return 2.75%, and you're covering it to the upside in the event that you get this thing wrong. And I would also make the following point, which is that if it suddenly catches a bid and goes through that, it will not go to $10. So you're not shorting a trade like this at $3.30 and instantly you're going to take the risk that it goes to $10 in the event that it does, somehow catch a bid here. But I think that's a trade that just sort of caught my eye and attention. Definitely a little bit weak here. Underperforming today. Something to think about. I don't normally recommend short bets. You're probably not going to start seeing me come out with naked short stock recommendations. Who knows? Never say never. But I just don't like the asymmetry of trades like that. And, one of the things you have when you buy stocks is that you have some consolation that you're going to buy. If you're buying a growing business, maybe you overpay a little bit in the short term, but growth cures a lot of problems. So if I overpay for a stock by 15-20%, and I never, I'm not going to claim that I'm perfect at picking bottoms, but the company's growing quickly and good management, all the fundamentals are there. Generally things are going to work out over the long run. On the short side, I have seen some brutal shorts in my time. We didn't really short that many single stocks myself because the guy that I worked for at the time, he didn't like shorting single stocks either. So his attitude was he would buy a portfolio of stocks and then maybe do something like short the mid-cap Russell ETF against it just as a hedge, partially. But I saw one firm lose, it was probably, and I am not kidding about this, $250 million shorting Netflix several years ago. Now, luckily for them, they ended up covering their short position. They were short 1 million shares. I was around when they covered it through one of our equity sales traders, and then they came to me and said, "Hey, we still hate it." And most of you will know that I actually like Netflix, so it was kind of funny that they would be coming to me for this. But they said, "Can you come up with an options short idea so that we can still press our bearish bet without, blowing up any more capital?" And so we put some puts on, bought a lot of puts. And I remember that the stock actually did crack very shortly thereafter, and it rolled over, and these things were massively in the money. And I contacted the trader, and I said, you want to cover some of these puts, or what are we going to do here? And no, not going to cover. Netflix fell even further. No, we're not going to cover. And then finally, guy rang me up and he said, "You know what? We're gonna take profits on that." They had at that point made about half of their initial losses back, I think. I don't have the exacts, but I just remember thinking, getting too married to a big short position in a growing stock is just a disaster. And frankly, had they maintained that short from that day forward, because they thought that the company was never going to be profitable for whatever reason, it would have just gotten that much worse, because Netflix has done spectacularly well since that time. Oh yeah, so we have a question from a prior video. What do you think about too much money, depreciating dollar if interest rates lower, chasing too few quality equities or other assets like crypto? Thanks, Lori. Well, you probably already know this, but yeah, I mean, this is the problem we're in, and that is that we have, for many years now, had too much money chasing too few assets. We've had too much money, period. So forget about the asset chase component of this. Excess transfer payments, excess debt, money printing in the form of QE, and ZERP were all flawed strategies. They have elevated asset prices, and they have caused inflation. And elevating asset prices is not the same thing as saying, is it therefore bad to buy them? And the answer is no, because if you have excessively easy monetary policy, what is your alternative? If they're printing money, or if the money, or let's just say this, if the financial system is also printing money, right? So it is not just, money creation does not just come in the form of the Treasury printing bills. It does not just come in the form of the Fed having interest rates below where the rate should be, or in the form of quantitative easing. Those are all forms of it. But the banking system itself also creates money. Governments running excess amounts of debt. You know, you have money creation in all of this. And the alternative to owning growing assets is to do what? Keep your money in cash? That's clearly a disaster in that environment. So it does mean that sometimes you will see you'll see valuation expansion, and that's going to occur for a couple of reasons, not least of which is also relative returns. So when you saw rates go down very low, people take incremental risk. People expect to earn a certain adjusted rate of return. So it expands multiples, and we saw all of those things take place. But so I don't feel good about it. That does not mean that I think that people should sell stocks, just to be clear, because I don't think that. Now, I will also say that I don't think that it is appropriate, therefore, to say I would pay a PEG ratio of 1 for NVIDIA. So a PEG ratio of 1 for NVIDIA on a 50% growth rate would be about 80% higher than the stock is right now. And why would I not do that? Because that growth rate can't persist forever, right? So I have to assume that that's going to stabilize or even turn down at some point. So how much money are you going to make on your investment between now and then? One of the reasons I rather like Amazon at its current multiple is because the growth rate and the multiple seem sustainable for a good period of time. And that's why I think Amazon is cheaper than NVIDIA, simply because I think that they're, if you tried to extrapolate their numbers further out, that makes more sense to me. But yeah, I'm not crazy about it. I'm sure none of you are either. It is the reality. And it's the reason we do this. It's the reason we invest. And we'll talk more about that when we do our next video, which is going to be next Monday at 4:15 Eastern Time. I think I mentioned yesterday, or Mark did, that because of the abbreviated week, he actually has a full course schedule. Apparently that got adjusted. So Tuesday he normally has office hours at noon-ish Eastern Time. But next week apparently he's teaching 6 classes or something like that. So there are no office hours. And if he doesn't have office hours on campus, we don't get office hours on video. So sorry for that. But hopefully we'll be able to do it the week following. And until then, thank you all very much for watching.